Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. On today's show, we're looking at a dynamic in the Toronto real estate market. This is a market that, quite frankly, has been decimated over the last couple of years. Since the increase in interest rates, I would describe the condo market in Toronto as being in free fall. New units have not been selling, investor purchased units have been experiencing negative cash flow, and the traditional group of buyers for new condos has virtually dried up. Well, one major announcement in the Toronto real estate market may have quietly signaled the bottom of the condo market, not because prices suddenly surged higher, and not because sales volumes recovered, and certainly not because sentiment turned optimistic. In fact, the opposite is true. The signal emerged because institutional capital stepped in at the precise moment retail investors have completely disappeared from the market. A newly announced $1.3 billion acquisition fund, backed in part by the Ontario government's Building Ontario Fund, plans to purchase large inventories of newly completed but vacant condo units across the Greater Toronto Area. The strategy is straightforward. Buy unsold condo inventory from stressed developers and convert these units into long-term rental housing. This is not a small pilot project. This is a large-scale institutional intervention in one of North America's most overheated residential real estate markets. In my view, it may eventually be remembered as the moment Toronto transitioned from a speculative condo market into an institutional rental housing market. For more than 20 years, Toronto's housing growth model depended heavily on condo investors. Developers would launch a tower, retail investors would line up in droves to buy units during the pre-sale period, banks would provide construction financing once enough units were pre-sold, and by the time the construction was complete, prices were often substantially higher. That model worked beautifully until it didn't. It worked beautifully in a falling interest rate environment, but the model was fragile. It depended on continuously rising prices. It depended on cheap debt, favorable financing, and endless investor appetite. Today, all four of those ingredients are broken. Interest rates are much higher than they were during the boom years. Condo investors who expected positive cash flow discovered that the rents could no longer support financing costs. The game of buying a condo on paper and then assigning the contract virtually dried up. Foreign capital retreated, and suddenly developers found themselves completing towers into a market where buyers were no longer lining up. The result has been a dramatic increase in standing inventory. There are now thousands of completed but unsold condo units sitting vacant across the city. Some projects are facing refinancing pressure. Others are delaying launches entirely. Condo pre-sales have collapsed to levels not seen since the early 1990s, and in some segments, sales activity has fallen by more than 90% from the peak levels. And here's the important part. Markets don't bottom when the news is good. Markets bottom when strong hands begin buying assets from weak hands during periods of maximum pessimism. We saw this during the great financial crisis in the post-2008 period in the U.S. In my view, that's exactly what this fund represents. Institutional investors are not emotional buyers. They don't buy because they're afraid of missing out. They buy when pricing disconnects from long-term intrinsic value. The institutions behind that initiative are effectively making a very large bet that Toronto housing is temporarily oversupplied today, but structurally undersupplied over the long term. And frankly, there's a compelling argument for that thesis. At the same moment, developers are struggling with excess inventory, new condo launches have completely dried up, construction starts have collapsed, many projects no longer make economic sense under current financing costs. That means the pipeline of future housing supply is shrinking rapidly. And today's oversupply may well become tomorrow's shortage. So real estate markets are cyclical because development itself is cyclical. Developers respond to price signals, and when pricing weakens and financing dries up, projects get canceled. Population growth doesn't stop simply because developers hit pause. Toronto continues to experience strong immigration, limited land availability, restrictive zoning, very difficult and lengthy approval processes, and high replacement costs for new construction. These structural realities don't disappear just because we're in a downturn. What changed was the financing model, and that's where it gets interesting. For years, Toronto effectively outsourced housing production to small-scale investors. Mom-and-pop condo investors became the dominant source of equity capital for residential construction. Those retail investors are exhausted. They've headed for the exits. I never made any of those types of investments. Most of the folks realized eventually that the carrying cost exceeded the rental income. Others are facing mortgage renewals at dramatically higher rates, and some are simply unwilling to absorb the years of negative cash flow while hoping that appreciation is going to make up for it. The institutional investors see opportunity where retail investors are seeing pain. Now, unlike small investors, institutions operate with lower cost of capital. They have a longer investment horizon and they have operational scale. So they're perfectly comfortable owning professionally managed rental housing for decades. Instead of tens of thousands of individually owned condo units, future housing stock may increasingly be owned by pension funds, by private equity firms, by sovereign wealth funds, and large rental operators. It's resembling what happened in the U.S. after the global financial crisis. The difference is that Toronto is doing this with vertical housing instead of individual single-family homes. And here's another important implication. The fund acts as the liquidity backstop for developers. As you think about that, have an awesome rest of your day. Go make some great things happen, and we'll talk to you again tomorrow.